Okay, good morning, good afternoon, and good evening to everyone. As always, a massive thank you for taking the time to be here today for the latest session of the Trading Vault webinar series with VT Markets. As always, introduce yourself on the chat. It'd be great to know where you're coming in from today, the level of experience, how you're getting on with your trading. That would be great to hear. Just while we wait for a few more people to join the call. So yeah, if you could introduce yourself, let us know where you're coming from. As always, towards the end of the session, we will invite you to stay on the call just to answer a few questions, a little survey just to give us some feedback and offer some topics that you'd like to see on the webinar series. We've covered so far. We've covered price action. We've covered risk. And today we're going to cover mastering support and resistance as well. So Rainham and Essex, that's not too far from where I am, Denise. I'm in Kent actually. So yeah, you're not too far from me. Um, Norway, great. Malaysia, awesome. So yeah, I know we've got a whole host of people from all over the world. So it's great to see such a diverse mix of people coming and taking the sessions seriously and taking the information here to help you with your trading. Rugby UK, okay, a little bit further north from me here, but yeah, all good. Italy, Philippines, Spain, been trading for a while. Yeah, that's very very common. For it to go well for a while, and then when you go hit a bad patch to struggle through that as well. We will cover as we go through some different topics in this. We will cover sort of mindset and how to help with that sort of side of things as well. Um, California, great. London, Myanmar, Canada, great. So yeah, great mix of people from all over the world. Tanzania as well, Africa being represented, New Zealand, UK. Brilliant stuff. Okay, cool. So, look, as I say, we're going to cover a variety of different topics throughout this webinar series, as well, from sort of understanding how to read price action, strategy, mindset, risk, the whole lot to really give you the tools to be successful at trading. We do want to tailor it to yourselves as well. So if there is anything that you would like to covered, as I say, there will be a survey towards the end. But today we're going to talk about support and resistance within the markets. Now, support and resistance, if you have been trading for any sort of length of time, you will understand that support and resistance, you'll understand the basics of support and resistance. But we're going to talk and we're going to delve a little bit deeper today into sort of the real characteristics that you want to be looking for in the market as well. So let's see what the time is. We've given it a couple more minutes, but yeah, so today, as I say, it's talking about mastering support and resistance. I think a lot of people overcomplicate this process as well, or try to overcomplicate it when actually it's fairly simple. And also a lot of people, as we'll talk about as we go through the session, we will talk about how if we can identify the right areas to trade from, it really gives us that edge in the markets and the higher probability. I know there from the previous sessions there is an appetite for some live trading, so that will come throughout the series as well. We're talking about scheduling that in over the coming months as well. It's like a live trading session with myself to really sort of show you how I set up the markets for each of my trading sessions. But actually today what we're going to do is we're going to do a very similar sort of exercise. So we're going to go through the material as always, but we're actually going to go and look at some charts in real time and plot support and resistance zones to show you exactly what we need to be looking for from support and resistance zones, to identify the right ones that we want to trade from, and also the right ones that we want to use to manage our risk. But we'll delve into that a little bit deeper, but we will get into some real-time charts and analyzing some charts as well. So hopefully you'll gain some real valuable experience from that. As always, please do ask questions as we go through. If it's relevant right there and then, I'll try and keep an eye on the questions and answer it then. If not, we will have a Q&A towards the end of the session as well to answer any questions. And if I do miss any, then I do apologize. It would not be intentional at all. Please, just towards the end, if I have missed one that you've asked throughout the session, please just repost it, and I promise I'll answer it then. So let's move on and let's get on with the presentation now. So just a quick introduction to myself. My name is Ross Maxwell. I am the VT Markets Global Operations Strategy Lead. My role here is to provide high-level educational content for traders of all levels, whether that be beginner through to very experienced. I am a professional trader. I'm an investment manager as well. I've got more than 20 years experience trading the financial markets. I started my career in London. I spent several years in London and Hong Kong and became an independent trader in 2014. I'm an award-winning trading coach and mentor, and I founded a online trading education company called Key Zone Traders, which is where I've been mentoring and coaching traders from around the world for the last 7 or 8 years now. So, onto the main subject of the presentation. So we're going to talk about support and resistance, but first of all, I want to talk about smart money. I'm not sure if you have heard of the concept of smart money in the past. Has somebody raised their hand? Yeah, hi, Jose. If you would like to ask a question, please fire it into the chat, and then I'd be more than happy to help. So yeah, smart money is basically the institutional order flow. It's where the institution is. It's called the smart money. It's because it's where you want to be when you're trading. Okay, so one of the biggest issues traders face that I have found through my many years in coaching and trading the financial markets is not knowing where to enter the market. Traders enter in low probability areas and chop zones. So and this goes back to the question of when there was someone on here earlier on who said they do well for a while and then they sort of give it away quite a bit. And this is generally what happens is people can do really well, but when the market context changes, they continue to try and force trades, and they get involved in these sort of choppy areas, and they can throw back and give back a lot of their hard-earned gains. So we want to try and avoid trading in those areas of the market. So what we want to do is we want to identify high probability areas, so we then have a blueprint on where we need to be trading from. So following the smart money. Now, if for those of you that were here for the impulsive and corrective price action session a few weeks ago as well, the markets and their directional movements are controlled by institutions. They're not controlled by me, they're not controlled by you, they're not controlled by the retail market. They are controlled by the institutions, because it's the institutions that have the volume of order flow that is capable of moving the markets. We do not, as a group or a collective group of the retail market, but the institutions do have this ability. They have the order flow, the volume of order flow to actually move the market. So the directional movements of the markets are controlled and dictated by institutions. And this is what we call the smart money, because it is the smart money that will move the market, and the smart money will be trading from the same areas as these institutions are entering the market. So we need to be able to try and identify where the smart money is entering the market. And if we can do this, then we know where we should be entering our trades. And this was really the basis of my trading. When I worked in London and Hong Kong, I had institutional order flow. I had the information of institutional order flow because the institutions were coming to me with their orders, and I had the knowledge of the volume of institutional order flow that was there. But when I left the city, when I left London, when I left Hong Kong, and I started trading for myself, I lost access to all of this information. So I had to try, I knew that was the order flow that moved the market. So I had to try and identify a way of trying to visually see within the charts where this order flow was coming in from. And that's the basis of where I decided around support and resistance and the basis of my style of trading. So we're going to talk about trading with zones. So institutions do not group all of their order flow at one particular level. If we sort of sat there and said the institutions were going to buy the Dow Jones at 35,000 or 37,000, whatever the level would be, then all the order flow would be there, and we would see that in the market, and it would be very, very easy to predict. But because of the volume that they have to enter the market, they cannot put it in at one particular level. And this is why I look at support and resistance as a zone rather than one level. I'm looking for areas of confluence and clusters of order flow that absorb the opposing volume. So if you're looking to buy, it absorbs all the seller's volume and then makes the market move in the opposite direction, and vice versa. Because if I can do this, then it enables me to identify where the smart money has seen value before and is likely to see value again. So again, we're just looking for the areas in the market where institutions have moved the market before or have caused some directional movement. So when we're looking at zones, very simply, if price is trading below a zone, then we want to view that zone as resistance. And we are going to get into how to plot these zones and how to, like, a bit of a guideline on how to do it. And then we're going to go into a practical example as well. But if price is below a zone, then we should view that zone as resistance. If price is trading above a zone, then we should view that zone as support. And we can treat these zones as inflection points because when price enters these zones, there are only 4 possible outcomes. So when you're entering a zone, you want to ask yourself these questions as to what you expect the market to do. So price can either respect the zone and reverse. So the institutions continue to participate in that area of the market. So if it's an area of resistance, price will enter from beneath, move up into that zone, respect the zone, and then reverse and sell off again, and vice versa if we're moving into a zone of support. Price can break the zone and continue to create a breakout. So we see price entering a zone where there's been historical order flow, but there is no more order flow there anymore. So the institutions aren't participating, and price will move up through that area and continue higher if it's moving through resistance, or moving lower if we're moving through support. And we see this often in trending markets when we see that impulsive price action that we discussed in the opening session. We can also see a breakout, so price enter the area, try to break out and reverse, creating a false break. So again, you generally see this where the price moves above the zone and quickly reverses. And we are going to cover these sort of false break trading strategies in a future session, like how to identify them. And we're going to talk about, you probably heard, I know it's come up in one of the previous sessions, about stop hunting. So we're going to discuss that. And this is basically what you can potentially have around these zones, is where price tries to break out, reverses, grabs those stops, and then reverses and respects the zone. The other thing is obviously price will oscillate back and forth, and it does not respect the zone at all. So again, from that third example where we're trying to create a false break, the market moves through, but then the order flow kicks in and it reverses and goes back in the opposite direction. If there is no order flow there and we're not trending, then price can oscillate back and forth, does not respect the zone, and therefore we do not want to see that area as relevant in the market anymore. So how do we plot zones? How do we plot these zones of support and resistance? What sort of things are we looking for to be able to identify the support and resistance zones that we want to identify to be able to facilitate our trades in the market? So to identify a zone, we need to establish where price has reacted historically. Now, this can either be as support or resistance, and ideally, in most cases, we want to see two-way order flow. So we want to see an area act as support and resistance at times. Because once a zone of support has been broken, it can turn into resistance and vice versa. And this is because institutions have seen value there before and are likely to see value again. So again, going back to those options of what could potentially happen. Now, obviously, if we see a zone as resistance, we're going to be looking for reversal patterns in that area. However, if we're in an upward trend and price breaks that clean, that it was a really strong area of resistance before, but price breaks through it, we can now treat that as support because we know that price is attracted to previous areas of order flow. So once it's been broken, even if you see it as resistance, once it's been broken, that does not make it irrelevant. We can often get some really, really good trades on retests of that area as long as it's with the trend. So if we see trending markets breaking through areas of resistance, we can then treat it as support to try and use it to get long. And if we see a trending market break areas of support, we can then use that zone as resistance to try and get short on a retest. So Riddell, yes, this will there will be a replay sent out, I believe, to all registrants. And Jackie, who are the institutions? So these are your sort of the people who have the big volume. So the institutions are your banks, they're your pension funds, they're your hedge funds, all your funds and banks that have access to huge volumes of liquidity and are participating in the market. Okay, so what do you want to look for when we are trying to identify our zones? We want to look for clear swing points. And again, we're going to go through this in a moment on a practical example. So for those of you that are aware of what a quick clear swing point is, that's great. For those of you that may be new and not too sure, we will identify this shortly. We want to see multiple reactions from a particular area that can be as resistance, as support, or both in the same area. And we want to see price reacting cleanly and respecting that area. If price is not reacting cleanly, as in there's a lot of wicks either side of the zone that you're plotting, then that tells you that the institutions are not participating aggressively in that area, and therefore we do not want to be participating. Again, it just comes around, and again, we're going to talk about this towards the end, at the end of the session, but if we're using these areas to identify entry points, and we have really long wicks either side, it's very difficult to know where our stop placements are going to be, or it may create wide stop placements, affect the risk to reward on our trades, and therefore reduce the edge on our potential trades. So we want to see price reacting cleanly and respecting an area. We also want to see strong area of support or resistance that has been broken impulsively but has not yet been retested. And again, there's an example of this of a trade that I'm actually looking at the moment, so I can go through some levels and some areas of the market that I'm actually looking for myself at the moment. And there's a couple of areas of these that I can show you today as an example, but we'll look through that in a moment. So by identifying the zones, we know the exact area of the market we want to enter our trades. If we're not in one of the zones that we identified, we should not be entering the trades. We should not be entering a trade because we're not in a high probability area where the market is going to move from. So by entering our trades in these areas that we identify, it will give us the highest probability setups. So we only want to trade the best zones with the cleanest price action. So how do you calculate zones? Now we're going to go into this in a moment as well. So we're just going to give you a bit of an outline of how we want to plot the zones. Now, support and resistance in and of itself is subjective. Okay, there is no exact formula. The way that I will plot my zones will be different to the way that you will plot your zones. The areas will be slightly different. If I'm plotting a zone on the DAX from sort of 22,000 to 22,100, and you have it at 21,990 to 22,090, so you've got like a 10-point difference in the zone. That's absolutely fine because we're both looking in the same area. So although it's slightly different, it's still in the same area. So there's not like an exact mechanical science that can allow you to plot these zones. Otherwise, it would be a lot easier. It is slightly subjective, but as long as we're identifying the right characteristics and we're identifying similar areas, then we are going to give ourselves the best chance of creating high probability setups and create that edge in the market. So if our zone is too wide, it will suggest unclean price action, and we do not want to trade from that zone. As we've mentioned, we only want to trade from zones that have clean price action. And if the zone is too narrow, we then leave ourselves little room for error because, as I say, it is subjective. We may be slightly off in compared to what the market or the institutions are seeing themselves. So we need to allow for that little room of error. So how do we calculate a zone that is too wide, too narrow, or the perfect size? Well, as I said, it's not an exact science, but this is the general rule of thumb that I use, a general calculation that I give to my students and the traders, and as an idea that I use myself to give us a guideline. So for this, you need the average true range, the ATR plotted on your chart. Now, for those of you that are not aware of what an average true range is, this is the average of the volatility in the market at that time. So you want to find the approximate value of the ATR line on the time frame and instrument of your choice. And equally, towards the end, I'm happy if to open this up and take one or two suggestions on timeframes and instruments that you would like us to analyze, and we can go back and go through those as well. But once we've got that approximate value of the ATR line on the time frame and instrument of your choice, you want to divide that number by 2, and that will give you a guideline on how wide your zone should be from the highest to lowest point. So let's go and have a look at this in real-time action. So one of the most popular, so if I could just please confirm that you should now be able to see my screen. Can you see my screen chart which has oil on it? It's a 4-hour oil chart. Can you please just confirm that you can see that before we get on? Brilliant. So Denise has confirmed that you can see that. So what we're going to do, we're going to just let's scroll out a little bit. I need to scroll out a little bit more actually. Okay. So this is the 4-hour oil chart. Okay. Now, what we're trying to do is we're looking for really clear swing points. So what is a clear swing point in the market? A clear swing point in the market is where you've got a clearly identified high or a clearly identified low in the market. So what we're looking for, we are looking for a clear swing point here. We're looking for clear swing point here. We've got clear swing points. There's several over here. I won't identify all of them, but you can see there are plenty of where are we? Clear swing point here. So we've got areas in the market where we've got clearly identified areas where the institutions have reacted from. Is that clear for everybody? That is a clear area in the market. Those are clear areas in the market where the market reacted from. Is that okay for everyone? Perfect, great. So what we want to do, let me just delete these for a second. We're looking for areas, as I said, that have got clear swing points and have reacted from a similar area multiple times. So we've got the ATR line down here. This blue line down here is the ATR line. You saw this sort of spike up here. This was during those tariff announcements at the beginning of April. And when that happens, your zones are going to have to get a bit wider. When we see spikes in volatility, they are going to get a little bit wider because you need to allow for the market to move and breathe. But generally speaking, you can sort of see that the, let me just get that there. So that line across there is sort of a good indication of an approximate level for oil, which is around about sorry, I can't see my screen here. Is about $1.14 you can see on the right-hand side there, can you just confirm you hear me? So on the right-hand side there, it says around $1.14. So we're looking to divide that number by 2, which gives us sort of about 55 to 60 cents, a 55 to 60 cent number. So when we're plotting our zones, we want to be plotting our zones to be around about 60 cents wide. Now, if you're plotting them 50 cents wide, that's okay. If you're plotting them up to sort of 70, 75 cents wide, that's okay as well. But you want to keep it within that sort of boundary. If your average true range is $1.20, you don't want to be having $1.20 wide zones, because your zones are going to be too wide. It's not suggesting clean price action. So let's have a look and see what we mean by this as well. So let me just take that off so we can move this over. So what we want to do, we want to draw our zones. Now, we draw our zone on there like this. And you can see straight away why, hopefully, you can see why I would have this zone as a zone of resistance, or a zone that I'd be interested in looking at. So I'm going to make this red. I also want to make sure that it's only about 60 to 75 cents wide. I'm going to make this 75 cents wide because oil can be quite a volatile instrument. But you can see just by plotting it there, this is around $1.20. So we're going to make this let's make this $65 to $65.75. Okay. So you can see here, we've got these clean swing points in the market that we wanted to identify. We said once we have a good, strong support zone that has broken impulsively, we can look to that area to be retested again. So in oil, once we had broken down from that area, I have been looking to trade from this area ever since then. Okay, so we came up and we almost got it here. We came down and we've just come back up in the last couple of days and had tagged this area here. And this is actually a trade I'm in at the moment. You can see we've had this spike above it. Now, depending on, and we're going to talk about this towards the end in regards to stops and entries and targets and stuff like that. But you can see this spike above it. Now, you could look to sit there and say, well, that's your reversal signal. You know, it's a pin bar, nice pin bar from the area, and that's your entry. You would already be nicely in profit. And again, this goes back to, if you take every single pin bar on the chart, you will lose money, because pin bars don't work because it's a pin bar. But a pin bar from an area that you are looking to trade from and you've identified is a strong signal. So you use this as your entry signal rather than your strategy. But again, the highest probability ones are coming from these areas. So hopefully you can see this is an area that I'm looking for as an important zone in the market. There are other areas in the market that we can look for. So again, at the moment, a key area of support would be this area down here. Okay, because it's the clear swing point in the market. It's been touched twice, really strong reactions, really clean reactions from there. It's come down, almost what we would call a double bottom. Again, rather than trying to overcomplicate things by double bottoms, double tops, head and shoulders patterns, etc., etc., we're just purely identifying support and resistance and trying to make it as simple as possible. So we can make this one a green zone because it is support. I personally sometimes just use blues. I plot all my zones as blue because obviously once a zone becomes once a zone of resistance breaks, it can become support. So I generally use a generic color like blue, but this is completely up to you. For today, we'll use green and red just because that's the general consensus for support and resistance. And again, we'll make them sort of 75 cents wide, and you can see that would currently be my zone of support. Now, if this area of resistance, and outside of that, we have probably, if we zoom in, Bear with me. I might zoom in. We have another area. Can I duplicate this? We have probably another area in this area here, which also has characteristics for us to be interested in trading from. And again, we'll just make this 75 cents wide. Now, again, so from here, this one is a little bit not as clean as those other two that we looked at. However, you can sort of see that we've got support here, a clear swing point. Yes, it breaks through, but then we act as resistance. Remember, we're looking for action from both sides of the price action, so support and resistance. It breaks through again, and then it's acted as support several times now. Here, here. So what this is telling us is that the markets, the institutions keep defending this area, and they keep continuing to see value in this area, whether that be as support or resistance, and here as well. So that is another area in the market that we could potentially look to trade from. Can I explain again how you decided to put the zone box where it is in the middle of the chart? Yeah, so that's basically what I'm showing you here, is because we've got the swing point. So we've got 1, 2, 3, 4, 5 swing points, 6 really if you count this. And again, if we think about this from a purely statistical point of view, okay, from a mathematical point of view, trading is all about probabilities. We're trying to create a statistical edge in the market, okay, and just from a statistical point of view, okay, again, if we zoom out a little bit, every time that the market has entered this area, we've got once, twice, 3 times, and then 4 times here. So of the last 4 times the price has entered this area, and you could even class 5 because this is a bit of a front run. So if you had your zone a little bit lower, you've got 5. Only once did it fail to respect it. So that's 3 to 4 times. So that's, what's that? That's 75 to 80% of the times in recent price action that price has moved into that area, price has reacted. The institutions have entered the market and moved the market from that area. So that's 75 to 80% of the time we can expect on recent price action, we can expect to see a reaction. Now this one is a little bit more, it's not as clear. So you've got, of the recent price action, we reacted from it once here. We went through it and failed to react here. So that's 1 out of 2. Came back, tested it, reacted, 2 out of 3. Came back, retested it, reacted, 3 out of 4. Through, 3 out of 5. Reacted, 4 out of 6. Reacted, 5 out of 7. Reacted, 6 out of 8. So again, 75% of the time that price has moved into this area, either as support or resistance, price has reacted from there. So it shows you that the majority of the time that price enters there, the institutions are still participating in that area. Therefore, we want to be participating as well. All of this other area, there's not the reaction, there's not the clean reactions. The institutions aren't stepping in with the volume that is strong enough to move the market, and certainly not in a clean way. So we don't want to be trading in this area of the market, because that is where we're going to lose our money. By exercising patience and waiting for these areas where we can see the institutional order flow has been before, purely by the fact of the reactions from the area. And again, I come back to saying these are clean areas because you can see there is no overhang. When the market reacts from them, they react quite cleanly. Okay, all the wicks are within that zone. So all of the reversals are from within that zone. So That's what we're really looking for, is to try and create a statistical advantage for us. So um, Orhan, I'm not sure how you pronounce your name, apologies. But he said they're asking, can we use the same zones on lower time frames? You can plot this methodology, excuse me, get my words out. This methodology can be used on any time frame and any instrument. So if you're a swing trader, you want to be plotting these zones using the ATR on your higher time frames. If you're a scalper day trader, you want to be using the ATR and plotting these zones on your lower time frames. They can work on any instrument as well, because it's the fundamental theory behind order flow in institutions in the market. So Tina asks, how far should we look for this area? A day, a week, a month, longer? Again, this sort of it depends on the time frame that you're looking at. Okay, so this is a 4 hour chart. You don't really want to be looking back much further than this sort of area. So you want to be on a 4 hour chart, you're looking back a couple of months. If we where's the bear with me, trying to find the ruler on here. Um, Yeah, can't find it. I'm not sure where the ruler is on here, but basically you want to go back a couple of months on a 4 hour chart. Obviously, if you're on a 5 minute chart, you're going back less time. So, but if we're talking about say, let's call sort of 2 to 3 months worth of data, you're talking sort of about 250 to 350 bars back. Okay, now the reason that you don't want to go back too much further than that is because if you go back any further than that, you may as well just move up a time frame and adjust and analyze the market from there. So you don't want to go back much more than sort of like 250 bars, depending on the time frame that you're on. Obviously, if you're on a 5 minute chart, that's only going to be sort of like several hours. But if you're on a 4 hour chart, that could be sort of a couple of months. So it's not about a particular number of days, weeks, months. It's about the recent price action that you're looking at, and you want to go back maybe, yeah, sort of 250 to 300 candles. If you're going back further than that, you need to just move up a time frame. Una, yes, of course, there will be a recording sent out in the next 24 hours. That's absolutely fine. And yes, so absolutely good for reversal. So again, depending on, we're going to talk about this a little bit later. You basically look, once your price moves into these areas, these zones, you don't just have to use limit orders. You can use limit orders, and that's absolutely fine. We'll talk about this in a little bit, but you can just say, okay, well, we're now entering into an area which I view as resistance. So I'm going to look for a reversal to be able to trade that. And you could use this. This is a typical reversal pattern. You know, you've got a strong negative pin bar from an area that you're looking at as resistance, and you can then enter on a close of that candle, and then, like I say, at the moment this trade would be in profit. So again, you come down here, you have a doji reversal, and the market moves higher. You know, you could look for reversals in these areas. Again, down here, you've got your reversal candle here, market moves higher. There's different ways that you can use it. You can either use limit orders, or you can use some sort of reversal pattern, depending on your trade plan. There is no, again, this is more of a methodology than you know, a mechanical strategy that we're trying to teach you. This is so that you can take this away and implement it into your own trading. Farik, great question. From my experience, which time frame is best to be applied to? It works on all time frames. Honestly, I've seen it on daily charts, 4 hour charts. I personally use it on. I have used it on 5 minute. I'm more transitioning to just trading on 1 hour higher, but slightly higher time frame charts myself. But for years, I've used this on 5 minute charts. It works literally on all time frames. You just have to adjust the width of your zones in accordance with the ATR on your particular time frame. So you need to. That's the one thing that you need to be able to remain dynamic and adapt to. So Charmaine, I use the 1 hour chart, but there is again you may. If you're plotting this on the 4 hour chart, this is a 4 hour zone. If you want to move down to a 1 hour chart for execution, I think that's okay. If you don't really want to be going down to really lower time frames because there's quite a lot of room in here, you can still see a lot of noise in a lower time frame within a higher time frame zone. But so I would sit there and say, if you plot your zones on the 4 hour chart, you really want to be doing sort of like executing on the 1 or 4 hour. And if you're executing on a 5 minute, you really want to be plotting your zones on maybe a 5 or 15 minute chart, something like that. Just sort of like within a couple of time frames of where you're plotting your zones. So another great question, John. So John's saying you're shorting from your upper point of interest with plans to take profit down at the next points you've marked out. I am going to come. We're going to talk shortly as well about targets and how we can use zones, more minor zones, as places to manage our risk and target for our trades. Yeah, 1 minute trades are effective as well. Okay. Would this be applicable when there is red folder news as well? Yes, you can often see these zones when price spikes into these areas. They will react from them as well. I think we'll talk about this in a lot more detail in other sessions because we're gonna, if we start talking about that, we're gonna go off piste a little bit, and I'm just a bit conscious of the time. But what you want to see is I wouldn't, for example, I wouldn't trade this if we've got CPI figures out shortly. I wouldn't trade this if we're close to that area. But if we see a big spike and the market is extended into it, often we can see the market react from those. You probably want to have wider zones, wider stops in place to allow for spikes. We see a lot more spikes, so we will see a lot more of these sort of spikes above zones as the market hunts for liquidity. And again, this is information for other topics and other webinars that we will cover. But yeah, for sure, they can be relevant for red news as well. So yeah, just quickly. So basically, what we do is we take the ATR, the average ATR value on the time frame of our choice, and we divide that number by 2, and that will be roughly what the width of our zone is from the top of the zone to the bottom of the zone. And that will give us the area that we want to be trading from. Okay, so we will talk about take profit and stop loss shortly. So Farik, I hope I just answered that question. What's the difference between supply and demand, support and resistance? Nothing, Mackie. So they're basically exactly the same thing. Just different terminology for it. Okay, so hopefully that sort of showed you some examples. The moving averages are the 8 and the 20. They're just my general ones. Again, we discussed that in the impulsive corrective price action video. That's just my personal preference. Okay, so let's move back on with the presentation. We will come back to the charts again shortly as well. But we're going to talk about weighting zones, okay? And this is going to talk about when you mentioned about where we're going to target, where we're going to enter, and that sort of thing. So we're using these zones to identify where we want to execute our trades. Now, some zones are stronger than others. So while some zones we can use for execution, other which are more minor zones can be used for targets or to manage our risk from. So how can we identify the difference between the two? So strong zones are what we've discussed so far. We've got clear swing points. You're going to have price reacting impulsively from the level. So price is going to hit that level and move away very quickly. Price will have respected the area on multiple occasions in recent price action, and a strong area of support resistance that has been broken impulsively but has not been yet retested will also offer an area that would be a good strong zone. And again, we're going to look at a couple of examples very shortly. Now, a minor zone. This area will have been respected, but the reactions are maybe a little bit weaker. Price will react impulsively from the level as well, but maybe not quite as impulsively as before. Price will have oscillated above and below the area more frequently in recent price action, and a strong area of support resistance that has no order flow from the other side, and the reactions are getting weaker. And again, we'll talk about this in a moment in regards to some examples, but basically, again, it'll go back to the statistical probability thing that we mentioned about here. You know, these have in recent price action, all these zones in recent price action have reacted sort of 75 to 80% of the time. Some of the more minor zones may have only reacted sort of 50% of the time. So just naturally speaking, from a purely statistical point of view, when we're looking at the markets, there is less of a chance that the market will react from there. So why is this important as well? So if we go and have a look at some examples now as well. So let's have a look at silver. This is quite a good example at the moment of a strong zone that I am looking at, which has broken out and is bear with me. We need to go to a 4-hour, I believe. Okay. Yeah, so 4-hour chart here. So we just sort of zoom in one. So we've got an area here. So again, if we're on the 4-hour chart, we want to draw a zone. Again, this is the spike in volatility around April. So we're going to drag this down and say it's around there, which is about 47 cents. We're going to have about a 30-cent wide zone. So we can insert an object, insert that rectangle. We had this clear area of resistance, okay, that we have touched. So let's put this in here. 34, 45, that's 34.48 to 34.78. Okay. So you can see here, we've got two really clear swing points. The market reacted from them very well. This one is a really, really strong reaction. You can see the market sold off very, very strongly from there. Came back and we reacted from there again here. We've now broken through impulsively. This area has not been retested yet. So a retest of this area is going to provide a good opportunity for a trade location. So that is one thing that we're looking at. Hasn't got that two-way price action yet, but it is an area in the market that has really strong acted as really strong resistance in the past, particularly from this point, and it's with the overall trend. So we've got this obviously bullish trend now on the 4-hour time frame on silver. So we're looking for reasons to get long, and this is a good area to get long. So it's a retest of liquidity. It's a previous strong resistance area, and therefore this will act as a good area to get long on any retest. So I'm going to be patient. I'm going to be waiting for the area that the market to move back into this area before I get long from that area. Okay, so let's say for example I'm long in this area here. Okay, let's use the oil trade as an example. Let's use the oil trade as an example. Okay. So because this is actually a trade that I'm in. So where am I targeting on this trade? Now, a full target could potentially be down to this next zone here. You know, you get a really good risk to reward trade on here. If you had your stop above here, you're probably looking 5 or 6 to 1. However, there are clear. You can see across here. There's some swing. There's some price action in here where the market has reacted before. So we're going to enter another zone in here. Now again, you can see price is a lot choppier, relatively clean actually here, but you notice that the reactions are generally a little bit weaker, especially around here. Okay, the reactions are a little bit weaker. So what I want to do, this is what I would consider as a minor zone. Okay, so there's a minor zone here, which basically poses a threat to my trade. If the market moves into this area, there is the potential that the market will react. It's not necessarily an area that I want to trade from, but it's an area that I can identify as a danger to my trade in terms of the market could react from there. So what do? Do I use that as my full target, or do I just manage my risk either by scaling out or reducing my risk, moving my stop? Whatever your risk management strategy is, you want to use these minor areas of support and resistance as an opportunity to manage your risk. And there'll be several of these across the chart. So again, if we, let's say, for example, if we just move this up here for a second, say, for example, we come down and we hit this level here and we get long. Where do we want to target? Well, I'm looking at that area there as a really good area to target because, and again, you know, we've got support here, reaction's quite weak, price moves through, comes back, moves through, comes back, acts as support. Again, not such a strong push up. Through, little bit of resistance, through, resistance here, unclean price action here before acting as support again here. So if we go back to that statistical probability, okay, we've got one reaction here, albeit very weak. Second time it goes through, comes back. Third time it goes through. Fourth time it reacts. So that's 2 out of 4. Through 2 out of 5, reacts weakly here. 3 out of 6. Through 3 out of 7. Through 3 out of 8. Reacts here. 4 out of 9. Through here, sort of 4 out of 10, and then reacts again here 4 out of 11, and then reacts here, so it's 6 out of 12. So it's only about 50% of the time price is reacting from this area. So statistically, I have a lower edge because it's 50% probability of a reaction than I would from one of these other areas that has a sort of 75-80% probability of reaction in recent price action. So if I'm long from this support zone, I can target this area because I know there's a 50% chance that the market is going to react. Therefore, I want to be reducing my risk or even taking my profits in that area. So does that make sense to everyone in terms of why something has similar characteristics in terms of multiple reactions and swing points, but it's a little bit less clean? The reactions are not as strong, and why I would not want to enter from those markets, but I would want to use it to manage my risk and mitigate my risk and maybe even take my profits. So the difference between we identify the zones that we want to enter our trades from by using those really clear strong zones, and once we're in the trade, or once we've identified a trade, we want to look to the areas of the market that we expect the market to move to be able to work out whether the risk to reward makes sense on our trade. Exactly, Steve. It's less clean, seems risky. Our job as traders is to mitigate risk as much as possible. Therefore, we want to stick to those zones that are less risk, higher probability. So Sal, that's a great question. So Sal asks, could I explain how a market manipulation zone can be identified in order to take the most profitable position after it? I'm going to cover that in a future session, so I don't really want to give too much away at the moment. It's I'm very conscious of time. We're pushing an hour already, Sal. So that I can assure you that talking about that in depth, how it happens, why it happens, how to identify it, how to actually take advantage of it rather than fall victim to it, as well as strategies to do so, will be covered in depth in another session. Okay. So for a good question again on ATR, is it a default? So this is set at a default, which is 14. It doesn't really make too much difference. I think just stick to the 14, the standard default settings for the ATR is absolutely fine, Farik. Okay, so hopefully that can show you what the differences between a minor zone. But now, how are we going to use the zones in execution? This is the last point that I want to cover before we take some further questions and stuff and close the webinar. So markets do not move because of a particular pattern. As I say, they just because there's a pin bar that doesn't mean to say the market's going to move. Just because there's an engulfing bar doesn't mean to say they're going to move. The markets move because of order flow and liquidity from the institutions. It's that smart money. The institutions and their order flow move the market. So if we can identify where the institutions have placed their order flow before, we know where we should be entering the market to give us the highest probability setups, as we've covered in this session. Any pattern that makes up your trade plan should be your entry trigger within the zone that we have identified. So we identified an area in the market that we want to trade from. Once price enters that area, we look to our trade plans for our entry techniques and our entry triggers. Does that make sense to everyone? Rather than just going, okay, I'm going to trade a pin bar from here. Not all pin bars work. So by taking a pin bar from an area of support and resistance, strong support and resistance, increases the probability of that trade working, or an engulfing bar, or whichever pattern you want to choose. So for our entries, once we have identified the strong zones where institutional order flow is, we should only be entering trades inside these zones. Use the strategies in your trade plan to identify setups in this area of the market. Trading outside of these zones means you are leaving yourself to the mercy of the markets, as you have not no edge necessarily, but certainly a reduced edge. By trading from these zones, you give yourself a better edge in the market. And once you're advanced in terms of price action and understanding with risk management and execution, you can even use limit orders to enter from within the zone. So again, let's take it back to this oil trade. Okay, you could have entered here and the market moves down. You could have used a limit order. You just limit, you identify an area within that zone. You could enter right at the bottom of that. You could enter right at the top. You could enter in the middle. You could identify that you could enter from the one of these, that swing low point in the market. You might use that as an entry point. Whatever your entry point is, that's absolutely fine. You have to understand that if you enter at the back, you're going to miss more trades. You're going to have great risk to reward. If you enter somewhere in the middle, you're going to miss some trades. You're going to have better risk to reward. If you enter at the front, you're going to enter more trades, but you're going to have lower risk to reward. Or you can wait for a reversal, and that pin bar is your clear reversal. So you could enter on a close of that, and you've got clear stop, which is above your reversal pattern as well. So you've got different ways of entering. You can use patterns. You can, and you could have different patterns. That there's a multitude, like so many different patterns and so many different strategies that you can use. But as long as you're using that within from price within this zone, you're giving yourself a better edge. So you can either use limit orders, or you can use a reversal pattern once you've entered into that zone as your entry. So for your stop, now we know that we are expecting institutions to enter the market in the zones that we have identified. If they do, then we know the market should react from that zone. It should reverse. If it does not react, then we know that the institutions are no longer participating in that area, and we do not want to be in that trade. If the market moves through a zone, and again, a lot of people get so hung up on, so they would identify a zone, and if the market moves through it, it damages their ego, and they're like, no, I was right. It's a clear zone. Then they must sell from that zone. And what actually ends up happening is your emotions dictate your decisions. But if from a rational point of view, if price moves through that zone, then the institutions have not defended it. The institutions are not there anymore. They're not participating in that area anymore. Therefore, our edge is not there anymore. So we don't want to be trading from that zone. So we want to be out of that trade. We therefore can place our stops either below the zone of support or above the zone of resistance, and we want to allow for some room as margin of error, or for stop hunting, which is that sort of liquidity grab, market manipulation that we've spoken about before. So again, potentially for if you use this reversal signal as a thing, you can have your stop above there. But if you're using a limit order, you want to place your stop sort of behind the zone. So if you've got your entry, if we use that entry, sort of sit there and say, let's for argument sit there and say that we use that entry. Let's change the we'll use purple for our entry signal. So let's say, for example, we use that area there as our entry, that swing low. Okay, that's again, it's not saying that's what you should do, but it is just an option that we could use as an entry point. Okay, your stop wants to be above this zone. So your stop wants to be, you want to allow for a liquidity grab like here. So you want to allow for a room above there, sort of 50% of the zone. So you want to allow for that zone is 75 cents wide. You want to allow sort of 40 to 50 cents above that zone. So if the top of that is 65.70, you would probably want to have it around 66.20. So you may have even got stopped out of this if you had entered this zone from here. But that's okay. You know, not every trade works. But that's what you want to sort of allow. You want to have your stop above that zone with enough room to allow for this sort of liquidity grab if you can. And your target, as mentioned, well, let's talk about targets now. So that's where your stop B you want to allow. And again, if we entered from this area here, again, taking that swing point there, we want to allow for enough room if that's 59.85. Sort of 59.40-ish, something like that. You'd want to have your stop just below the zone. And again, if we'd entered on this trade here, we've got one opportunity, two opportunities, three opportunities there, all which would have worked from that zone. So you want to have your stop below the zone or above the zone if it's a zone of resistance, or above or below the reversal pattern that you're using, or the entry technique that you're using for your entry from that zone. And then finally, target. Well, whilst we expect the market to react from our strong zones, we know that they sometimes react from our minor zones. And we've spoken about this already. We can therefore use these zones as targets and to manage our risk. We do not want to enter from the minor zones as they are not high probability. Again, we spoke about the statistical probabilities of those. But there is a good chance that they can react, and therefore that represents a risk to our trade. We therefore use these minor zones to manage our risk or determine our targets. And once we know our entry, our stop, and our target, we can work out our risk to reward ratio and see if that trade idea makes sense. So just one last thing on that. So again, if we've entered here, our target would be that area there. You can see that our entry is around 60.20, our stop around 59.40, so we've got like an 80-cent wide stop, and we're targeting 61.70, so $1.50. So it's just under 2-to-1 trade. That to me is a risk reward trade that makes sense. Therefore, that would be a trade that I would be happy to take. And therefore, we've used our strong zones to identify our entry points, our stop placement, and we use our minor zones to enter to determine our entry to our target to determine our targets. Okay, everyone. I appreciate we are running over an hour now. It's quite an in-depth session. As I say, please do feel free to ask any questions. If I have missed any, then I do apologize. I will scroll through some now, and if not, please do repost them. There is a QR code on how to set up a live account with VT Markets. As I say, there will be a short survey after the session as well. If you could please stay on just to answer that, it will help us to make this webinar series as informative and tailored to yourselves as possible. And then that helps us give you the information that you need. But please, I hope you found this session useful. Please do let us know if you have any questions. So Tina, does it work for all instruments? Forex, does it only work for metals? Or no, it works for all instruments, all time frames. It is a fundamental ideology and a fundamental methodology across all asset classes and all time frames. It's a methodology of how the markets work. It's institutional order flow that moves all markets. Therefore, it will work on all instruments. Cool, great stuff. Some really positive feedback. I'm glad you found that useful. Yeah, you can do. I mean, it's completely up to you how you manage your trade. You can use trading stop losses as well. Absolutely fine. If you've got that side of things is really down to the individual in your trade plan. You need to have that backed up in terms of data and performance. But yeah, that's absolutely fine. Cool, good stuff. Great. You're very welcome. Thank you very much, Denise. Yep, including crypto. Again, if crypto is very volatile, if an instrument or asset class is very volatile, even if it's just going through a volatile period, um, if it's not offering clean price action, then you won't identify clean zones. If you can identify clean zones that show like institutions are involved in crypto. So if institutional order flow is moving the market, and it represents clear zones of support and resistance, then that's absolutely fine as well. And it goes for all instruments. All instruments will go through periods where there is not that many clear zones. Like not, and again, this is why it's good to look across different asset classes when you identify or when you're trading this way, because I'll give you an example. Aussie dollar, US dollar at the moment, I haven't seen a really good clear level on that for a long time. If I was only trading that market, I wouldn't have had a trade for a long time. So some markets go through volatile periods. Sometimes they go through periods where the price is just really unclean. And that's true of all asset classes and all instruments. It will go through some period of that at some time. But if you find the market which has clean price action, clean areas of support and resistance, those are the trades that you want to be. Those are the markets you want to be trading, and those are the areas of the market that you want to be trading. All indicators, how many percent accurate for trading? I'm not too sure. I don't think I quite understand the question, I'm afraid, Riolzo. No indicator is all indicators are lagging. I use indicators as a guide rather than an accurate way for trading. All indicators I use are purely as a guide for my trading. Um, Okay, so one last question from Farik. It said which moving averages do I use? I use exponential moving averages, the EMAs. Again, it's not again, don't get too caught up or hung up on using a specific one. That's my preference. It's the one that works for me. If you're using an 8 and 20 smooth moving average, it's going to be slightly different, but it's generally going to be roughly the same. So again, just going back to that original point about the indicators. Indicators for me, the more I've developed my trading, the more I've coached traders from around the world. Indicators are to be used as a guideline and a tool. They're not to be used as like the strategy or the thing. So don't get too hung up on being exact. It's just about using them as a guideline that works for you as well. So Stelios, that how to calculate the number of units to trade based on your level of funds per trade. That was covered in the last session on risk. If you haven't received that, then maybe if you can contact VT Markets to get the previous sessions. Yep, no, that's absolutely fine. Thank you very much, guys. So our time has come to an end. Thank you very much for your time today. Really appreciate it. As I say, please do stay on for that survey to help us tailor these sessions for you going forward as well. But hope you found that very insightful, and we will speak again in a couple of weeks at the next session. Thank you very much.